Welcome back to Be Rich. I have my friend and nephew Sashwat with me, and we are going to discuss a certain stock which he is going to pick up randomly.
Right. First of all, feels good to be back. And this is a series we've promised, though we couldn't do it with Indian companies because of certain restrictions on regulation. But this is something we can do with American and Japanese companies. So I figured, why not? Let's pick a Japanese company and break it down and look at the valuation and then decide whether it's something worth looking at. So this is the main idea behind this series. So the first company of this series which I wanted to look at is Subaru Corporations. So a lot of you might be aware of Subaru cars. They also make trucks, and that has the AWD four-wheel drive, which is the classic Subaru trait of the vehicle, which has its own niche in the market. And this is a company which also does a lot of other things apart from just producing vehicles, though most of their revenue comes from producing vehicles. Actually, they engage in manufacturing parts for the aerospace industry. So, and they do a few other small business models which also contributes to the revenue, but in very small amounts, which the majority of it comes from their car business and their aerospace business. And out of those two, the majority is the car business. So, and they were established in 1917. So I guess it's been over 100 years since they've been in business. And today I wanted to break it apart and show you some of the financials, the valuations, and then let's think about it. So what do you think about this company?
I think Subaru is a very storied Japanese company. It started as Fuji Heavy Machinery. Fuji was one of the Zaibustos, which after World War II was broken up into several parts, and five of those small companies merged together. And Subaru is a constellation of seven stars, with one being missing. That is why the Subaru's logo is six stars. Is basically the five Fuji companies which merged together. The first product this company made is a scooter, what was salvaged from World War II aircraft manufacturers. Subaru manufactured airplanes for Japan in World War II, and that is why they are still in aerospace. Subaru was at times one of the smallest car makers in Japan. It has a specialized design called a three-box design, and it always had an outside partner from 1960s. So originally Nissan was the partner. Nissan had 17% stake in Subaru, and then Nissan exited. Then GM Motors came, and one of the Indian cars, Chevrolet Forester or something, was a Subaru design. Then GM exited Subaru, and the GM stake was bought by Toyota. I think Toyota has about 20% stake in Subaru,
Little more than 20%.
and yeah, they are the largest shareholders. And what happens is a lot of Subaru vehicles are rebadged as Toyota, and lot of Toyota vehicles are rebadged as Subaru. So this is the basic skill. And also there is a collaboration between another Japanese car company called Daihatsu, which is a subsidiary of Toyota, and Subaru. So if you actually, this is a link of three car companies: Daihatsu, Toyota, and Subaru.
Yes.
And
So,
Subaru makes highly specialized cars
yes.
for the American market.
Especially for the regions near the Canada border where it's very cold, because that's where the
Yeah,
car is most useful. But anyway,
most,
before we get
yes.
into, I want to ask you on the moat of Subaru, and I want to ask a few more questions. But before we get there, I want to go through the financials with you so that we can go through some of the criteria which Uncle Warren might use, and then we can see whether it's a check or not. So I'm going to rapid fire go through the financials, and then I'm going to ask you for your review of it. Okay? So first thing, their EPS has grown at around an average of 8.5% since 2017 to today. That is, if you take the CAGR of their EPS, it's grown at about 8.5%. This is including the COVID years. Let's keep that in mind. So,
It is really good. That means their sales are going up.
right.
And they have a niche product in a niche area,
Yeah.
which they are dominating. It is very good.
Okay. And then let's move on to the next metric. That net income has also gone up by roughly 9% since 2017 to today. But the differential between the net income and the EPS could be chalked up to what reason do you think?
Dividends.
Dividends. Right. So, but the main point is that both net income and EPS more or less track each other, and we can then move on to debt. The total debt of Subaru Corporation is actually 522 billion yen, and the cash and short-term investments of Subaru Corporation is 1.92 trillion yen. So they have more than twice the amount of total debt in just cash and short-term investments. What do you think about the financial health?
Leverage in Japan is very good because like equity for you is zero cost in America.
Yes.
For a long time till now, till about 3 months back, Japanese loans were at 0%. If you are a corporate, you can buy it cheaper. The cost of debt is lower than the cost of equity. Therefore, I am not too concerned about debt in a Japanese company, given Toyota is its parent. Yes, now as the debt cost will start to go up now, it may drag the earnings potential. But in this case, 2 times of it is cash. If it goes up, they can always bring it down very quickly.
Right. So that was my question to you. I mean, this is sort of one of those ideal scenarios where you have a huge company that has more than twice the amount of its debt in just cash. And it's and one more thing. So we do know that its net cash is greater than the amount of debt. But another thing which I want to draw to your attention is the fact that their return on invested capital is also at a pretty high number of 14.2% in an economy like Japan.
It's extremely high. That is because most of Subaru's sales is outside Japan.
Okay.
They have a plant in Indiana, USA. So they have a it's a question of a niche market. They have a niche market and they do very well in a niche market.
Right. So yeah.
It's not a general market car.
Mm-hmm.
It has highly specialized cars for certain segments.
Right. That makes sense. So given these things, and I want to let you know that their free cash flow is almost equivalent to the amount of debt they have. Their free cash flow which they make in a year is about 450 billion yen, which is enough to pay off their debt in a given year. So I think the financial health of Subaru is very, very good. And given the financial health of it, where would you score it on a score of 1 to 10?
It's very good. It's about 8 on 10 or 9 on 10. My only worry about Subaru is they will do well in hybrid also because Toyota is a hybrid company.
Right.
But when the electric car comes, where will Subaru be? I do not know.
Okay, so
that's the question.
Do you think that their tie-up with Toyota might help with that?
Of course it will help, but Toyota's own transition, we are betting that Toyota will transit.
Yes.
They will have an ace up the sleeve. But it's something we do not know yet. Toyota has not had big winners in the electric cars market yet.
Okay.
That is my only concern of worry.
Okay.
But it is not going to happen now. But 10 years from now, Subaru should be having an electric car.
Right.
It should move from an IC engine to an electric motor because the IC engine is dead.
Okay.
It's dying. And it has to move on to an electric motor. And this is a 4-wheel car. So, how they are going to do the technology to transfer to an electric car. I think they have an electric car.
Yes, they do have one electric model.
Yes. So that is the transition I would worry about.
Yes. On that point, Subaru Corporation and then the motor company which is underneath Subaru Corporation, they forecast that their earnings might decrease by around 2% or 3% in the next 2 years.
Yes, it is quite likely because they do not have enough traction into the electric market.
Yeah.
And the biggest market is China. I don't know how well they will do in China.
So that's one thing. But then in my valuation model, I hope to account for this. But anyway, given that, I also want to talk about management quality. I mean, it's a solid Japanese company. They've been doing quite well.
It's a Toyota company.
Yeah.
Basically, Toyota can send somebody to manage the company. I do not worry about the management.
Okay.
I want to know how cheap it is because I have not looked at the price.
Okay. So let's get to the meat of this topic. So there are 2 valuation methods I'm going to be using today. Both valuation methods you've taught me, and let's see what you think. Based on the method you would use, I've used the same method for both these things, and this is going to be a learning lesson for me and the audience. So the first valuation method, I'm going to describe it, but I want you to explain to the viewers why this valuation method works. So the first valuation method of what I've done is I've taken the earnings per share and I've compounded it at different growth rates over the next 5 years. And then I've multiplied it by a range of PE ratios at the end of 5 years, plus whatever dividend compounded at 10%, and then discounted everything back to today. So that will give you your implied rate of return in each scenario.
Yes, basically what you are doing is you are assuming a very high growth rate, a very low growth rate, and a medium growth rate.
Yes.
And then your expected dividend, return on dividend, and discounting it today's rate. Yeah.
Correct.
Which will tell you where the market is today, where it ought to be.
Exactly. So this is basically the crux of what I've done, and the viewers are still a bit confused. Let's go through the process. So the first range I've picked up is the 5% growth rate. Even if we assume in the next 2 years that the earnings decline by 2%, I still think that on average it's possible for them to post a 5% growth in the next 5 years. And given reflecting this assumption, I've asked for a 5% EPS growth rate, and I've taken PE ranges of 5, 10 and 15. So mind you, today's PE ratio it's trading at is at the lower end of how it's ever traded, and today it's trading at a PE ratio of 4.85. So a PE ratio of 5 would yield it an 8.6% CAGR in the 5% growth category. A PE ratio of 10 would yield it a 22.5% CAGR. A PE of 15 will yield it a 31.9% CAGR. And then I've taken the 10% growth world. With the PE ratio of 5, the return jumps up to 13.35%. PE ratio of 10, the return jumps to 28%. PE ratio of 15, the return jumps to 37.9%. And of course, the unrealistic 15% growth scenario, a PE ratio of...
That won't happen.
Yeah, it won't happen, but...
Let's discount it.
Okay, let's cut out the 15% world, but with the 5 and 10% growth rates, these are what we can expect.
So I think we will grow at 5%. And because I don't think in the next 5 years you're going to go fully electric.
Yeah.
So I think 5% growth rate is a good assumption. And I'm sure that they will have enough batteries to come up with a battery car.
Yeah.
So and nothing to worry about.
And we do know from Howard Marks that so the median PE which they were always usually trading at is 12. So they're trading at 1/3 of their median PE because of what Trump is doing and all the macroeconomic factors involved. So and they also posted an earning guidance where they said their earnings might take a hit of 2%. So this is basically what has led to, or at least what I believe analysts to discount the company at a much higher rate. So given that, I think a PE ratio of 10 is quite possible. I mean, I think a reversion to the mean is quite possible.
Yes, yeah. 10 is a fair assumption 5 years down the line.
Yeah, 5 years down the line.
But your PE would have also gone up by nearly 40%.
Yes. So if your PE goes up to a metric of around 10, the world, according to the first model of discounting, a 20% return year on year over the next 5 years on Subaru is how the model says if you take these assumptions of 5% growth and a PE ratio of 10. But I want to move on to the more interesting model, which is the free cash flow discounting model. And here I take the free cash flow for the next 10 years, and then I assume at what growth rate it grows at over the next 10 years. I take a terminal value and I discount everything back by a discount rate that I've picked. So this is the DCF method that Warren Buffett has used, and I want to go through the growth numbers when we look at the DCF method for this. So I've assumed the same 5% per year growth rate for the next 10 years. And today the free cash flow stands at 450 billion yen. I've also said that the discount rate is 10%, and I've taken the terminal growth rate to be 2%. That is, after the 10 years, I assume that it'll keep up with whatever the Japanese inflation rate is or the US inflation rate is. And I've taken the terminal growth rate as 2%. So the table will be on the screen of how the 10 years look, and we take the net present value of the cash flows and of the terminal value, and we sum these up, and then we divide by the total number of outstanding shares to give us the free cash flow net present value of the cash flow per share. So the net present cash flow value of per share is 9,470 yen. What do you think about these assumptions?
See, I still don't have an idea of what is the current value of the share.
The current value
But
of
the
the
way
share
we
is
are
2,911 yen.
So that means you're going to get 3 times your cash.
Yeah.
The current value is 3 times your cash.
Yes.
That means the stock value should be at 7,000.
Yes.
So basically, what will happen is the current value will at least go up 5-6 times by that time the 10 years is over. So you have a potential 10 bagger in this.
Yes, but then my question is, all of this hinges on our assumption. So what do you think about the 5% for the next 10 years and the 2%
It looks good because,
terminal growth?
see, I do not know 2% terminal growth is something we believe about.
Okay.
But if they transit the electric car revolution,
Yeah.
I think Subaru has a good chance because it has a lot of American orders. So I think they will just go through the first 5 years. And the next 5 years depends on what is happening in the electric cars. I think they will manage and they will do far better than what you are estimating.
Okay.
But it is a small micro cap. My only question is whether you want to own it directly or you want to own Toyota. That's why I said it will be far higher. It will be 5 to 6 times your price.
Yes.
But the issue is this.
Yeah.
Whether you want to take a bet directly on this or you want to buy Toyota and through Toyota get 20% of this.
Right. So that's the thing. I'll get to that question, but I've also created a margin of safety for us in two scenarios, which I also want to show you those numbers as well. So I've also tweaked the assumption into that free cash flow declines by 2% per year for the next 2 years, and I've said that after that the free cash flow grows by 3% per year over the next the remaining 8 years of the 10 years. So I've taken a more safe assumption there. And then I calculated the same per value share, and that comes up to 7,440 yen per share. That's still
whatever happens, this stock will go up 5 to 7, 8 times in the next 10 years. In dollar terms, it's a very good return.
And the final metric that I want to cover here, with a 15% discount rate. So generally we don't use discount rates over 10% for a very financially healthy company, but a 15% discount rate. One second, I still want to show you what our margin of safety is on this. So even with the 15% discount rate declining the cash flow by 2% year on year for the first 2 years and only growing at 3% per year for 8 years after that, the net present value divided by total number of shares, it comes up to 4,545. So there's still 100% difference, more than 100% difference between what it's trading at today and what the net value of the cash is.
You will be very surprised. The discounting rate has to be 2%, and you are discounting it at 7-8 times that. You can safely estimate that this share will cross 10,000 yens by the time 10 years is over.
Right. So now you brought up a point about owning Toyota, owning Subaru. My fear with Toyota is that I'm very scared of the debt that they have on their balance sheet. It's a huge amount of leverage that they have on their balance sheet.
No. See, Toyota's by borrowing so much is because the cost of borrowing is almost zero. Yeah. Toyota will quickly bring down debt if cost of borrowing goes to 2-3%.
Right. But interest rates are going up. But their cash flows aren't enough to bring down debt as fast as what Subaru could do.
No, there could be a sale of assets. Toyota has a lot of assets.
That's right. But if interest rates are going up, we know that asset prices come down, right? What it fetches in the market.
No. The founding family of Toyota comes from an extremely wealthy family. They have a lot of industry which they have for a period of time. I'm not worried about Toyota's debt. But today Toyota is not as cheap as
Subaru is.
Yes.
Yes, Toyota is trading at 7.5 times earnings, whereas Subaru is trading at 4.95 times earnings.
And when we bought Toyota was also at 4.8 times earnings.
Yeah. So the reason why I wanted to bring up this company was I wanted to show to the viewers why value investing still makes sense. And Subaru's,
in Japan, this is how a stock market should be. Japan is highly developed state, but still there is a lot of value in that country. We are yet to be developed. Our markets have run ahead of us.
Yes. And we actually made a similar analysis for a company like HCL, but I guess we're not allowed to share it because of regulations. This is what we can share with you. And so what do you think about this whole exercise? What do you think maybe I should modify in the next edition of the series?
It looks great. Only thing is, We have to look at the holding company. In this case, Toyota holds 20% more than 20% in Subaru. If you buy Subaru today, it will at least touch 5 times its value if things don't turn out too badly.
Correct. So, that being said, if there's anything else you'd like to say, otherwise we can close out the
I
video.
think we'll close it out. I think for people like me who already own Toyota, you can consider. Thank you for watching Be Rich, and I hope you enjoyed this show. And I hope that we can do more Japanese and American companies like this, which are screaming buys. Once again, thank you for your support for Be Rich. I hope to see you in another video. Thank you.
Thank you.